Well, good afternoon, everybody. I'm Steve Orlins, president of the National Committee, and I'm thrilled to be moderating today's discussion on U.S.-China financial investment. This is part of the U.S.-China investment program series that the National Committee has done with the Rhodium Group now for 5 years. As the United States and China both contemplate policies that would limit future bilateral portfolio investment flows, the report that we rolled out this morning is now posted on our website and of course was covered in today's Reuters, Yahoo Finance, NASDAQ.com, US News, and other reports, adds new transparency and critical understanding to the US-China portfolio investment discussions happening in Washington, Beijing, and elsewhere. We're joined today by report authors, National Committee Board Director and the founder of the Rhodium Group, Dan Rosen, and RMB Lysenko, an Associate Director of Rhodium Group, to present their findings. We're also extremely fortunate to have two outstanding experts who will discuss the report's implications. Mark Wiedman is Senior Managing Director at BlackRock, a member of BlackRock's Executive Committee, and a National Committee board member. Constance Hunter is the Chief Economist for KPMG and a member of our Economic Track 2 Dialogue. All of the speakers' bios are available on the event webpage, so I won't dwell on their many accomplishments, because if I did, we wouldn't have time for the program. We'll have Dan and Adam first share their findings and then give Matt and Constance a chance to comment and respond to one another. Then I'll moderate a Q&A with the panelists. Dan and Adam, let me turn it over to the two of you.
Thank you so much. And it's so good to be back with you and the committee to take our collaboration to the next step here tonight. And release this report called U.S.-China Financial Investment, Current Scope and Future Potential. Adam, if you take it to the next slide, just to say how appreciative we are of our chance to work with the committee on this important work and reach a broad audience of Americans interested in the various ways in which the United States and China interact economically. Next slide, Adam. People think of China as already being a global power, but really it's only partway through the process of globalization. Further financial globalization truly is the next frontier in the process for the People's Republic of China. Next slide, Adam. We have at the Rhodium Group and working with the committee for 5 years anticipated these next steps that China takes in phases as they have unfolded. Going back a decade ago, we recognized from the late 2000s that foreign direct investment was poised to start taking off. China being a global foreign direct investor, not just a host of companies from around the world. And the chart on the screen in front of you shows the large value growth in Chinese FDI to America that we've tracked over this past half decade with Steve and the committee. And also, just as dramatic, the story of that starting to fall off in the past 2 or 3 years, largely because of capital account concerns in Beijing, not because of security concerns in Washington, although those have now become part of the story too. From the mid-2010s, we started adding to the story venture capital flows out of China. Venture capital into China had always been an important background story that those in technology knew well. But from 2014-15, we started seeing the beginnings of Chinese VC investment into the United States, a new channel in the relationship that also has extraordinary importance. Today, the next channel is primed to play a bigger role, and that is portfolio investment, stocks and bonds, holdings, not just China to the world, but also the world to China, because unlike FDI and other aspects, China had largely kept the door closed to this aspect of financial openness, even right up until recent years. Next slide, Adam. This shows the global picture of China's financial the extent of China's financial globalization and how far we have to go. There's a zero in the middle of the chart that goes from right to left, as you can see. And it's describing to the north of the zero, above the zero, are Chinese claims on foreign assets. When Chinese hold assets abroad, stocks, bonds, which is portfolio in red, foreign direct investment at the bottom, other credit that they've offered to foreign firms and whatnot, and then reserve holdings of US treasuries with their foreign exchange reserves. Below the zero, China's liabilities to the world, what global investors like Mark, for example, help intermediate for savers around the world going in and owning something in China. It's mostly been foreign direct investment in the past, companies taking that risk. But the big new story of the moment now, and what we're talking about today, is portfolio investment. Passive savers often, or active investors trying to make some money by holding stocks and bonds and other portfolio securities in China, the red underneath the zero. And as much as it's grown up to, China having north of $6 trillion of holding in the world today, and the world having almost $6 trillion of holdings total in China, if we do a very simple projection of what these numbers could look like in 2030, if China only became typical, had normal ratios of this kind of financial holding, normal the way that other OECD countries have, then we'd be talking about adding $15 to $20 trillion in each direction of new holdings, adding to China's net international investment position. We are going to be talking tonight about a particular bilateral pairing here in the story, United States and China, whereas this is a kind of global picture. But just to give us a sense of what the stakes are, it's really helpful, I think, to start with a chart like this. Next slide, Adam. But that picture is a picture of what would happen if things were normal. As economists like to say, showing off their Latin ceteris paribus, all things being equal. But as we know, especially after the extraordinary 4 years that have just passed, nothing is normal right now, not least for China and not for China financial potential either. There, in the headlines almost every day, have been stories about delisting China from American markets and blacklisting Chinese companies and pressuring American financial entities, public and private, from deploying capital into China. So we have here a huge question that we need to ask about what the numbers are and what the opportunities are, but we see policy moves already being made to close doors. And it turns out, as my colleague Adam is going to walk you through now, next slide, Adam, just for transitioning to you, as my colleague Adam is going to walk through, that the official data that we use to tell ourselves what we think the numbers currently are actually quite imperfect. And so if we don't even know what the present reality is, it's pretty tough to make good policy about what we want things to look like in the future. We learned that lesson and practiced it with the committee looking at foreign direct investment and VC in recent years. And now we're hoping to make this data contribution to better policy debate on the portfolio side. Adam, over to you.
Thank you, Dan, and good afternoon, good evening, or potentially even good morning, wherever you may be in the world. It's my pleasure to take a little bit of time now to walk through the data methodology and key findings behind our report. And as Dan said, the goal of this entire exercise for us has been to estimate the true stock of bilateral securities investment holdings between China and the United States at the end of 2020. And I want to start by explaining why that's difficult and why the work that we've done is valuable and adds an important bit of a light to an area that is really sort of obscure and difficult to fully understand. How have we done this? It's very difficult, it turns out, to track securities investments internationally nowadays. In the FDI and VC spaces where deal sizes are larger, where transactions are fewer, and where turnover is much less rapid, we've historically been able to construct these granular bottom-up data sets that shed new light on investment patterns, but this is just not possible in the securities investment space. The capital that is used to invest in securities is highly mobile. There are lower transparency thresholds, and small holdings are often exempted from any form of disclosure. Trading volumes are massive in liquid markets. Just to look at one market in the United States, in 2019, the daily average daily trading volume of US Treasury bills alone averaged more than $600 billion a day. And the ownership structures used in tracking nationality and ownership across borders are also very complex. And that's what's shown on this slide here. I want to lay out some of the examples of the most common types of investment structures seen among US investors holding the securities of entities from China. In scenario 1 here on the screen, you might have an institutional investor like a state pension fund who places money with a domestic asset manager. And that domestic asset manager may then in turn obtain Chinese regulatory approval to invest directly in the onshore equity securities listed on Shanghai or Shenzhen stock exchanges on this US institutional investor's behalf. This is relatively straightforward. And among the 5 scenarios I have on the slide deck here, this is the only scenario that would be accurately captured in the official data that most rely on to measure securities investments holdings across borders. But as I'm going to show here, there are a lot of other structures that are not actually accurately captured in the data that are equally important. For example, you might have a US retail investor who's purchased an American depository receipt share, an ADR share, of a Chinese company like Pinduoduo. These ADRs confer ownership of the underlying equity shares of Pinduoduo's Cayman Island holding company, which exists in this third country tax haven bucket here, which then in turn has a complex series of contractual relationships with the onshore Chinese corporation that infers a level of control and quasi-ownership. This type of holding structure shows up as a US equity investment in the Cayman Islands in official data and would not be attributed as a US investor holding a Chinese corporation. It's a similar case with number 3 here. You might have a high net worth investor who places money with an asset manager, maybe even outside of the United States. So you might have a third party, which in turn acquires the shares of a Hong Kong holding company, a firm like Sino Biopharmaceutical Limited, for example, that in turn controls a physical business in mainland China. Assuming the interposition of the asset fund manager in the third jurisdiction doesn't mess up the custodial holdings, would be attributed as a US investor owning the shares of a Hong Kong company, even though, again, that Hong Kong holding company has substantially all of its operations in China. Looking at the debt side in scenarios 4 and 5, you have another case here where you might have a US financial institution who might purchase the onshore debt securities of mainland Chinese company through an international subsidiary, perhaps using a mechanism like the China Interbank Bond Market Direct, the CIBM Direct program. This is actually not captured as a US investment in Chinese securities at all because it is made through an offshore subsidiary. In most official data sets, this would be considered an official holding in the official data as a holding of Chinese securities being attributed to wherever this offshore subsidiary is located, even though it's owned by a US corporation. Finally, in another example here, you might have a US institutional investor like Prudential or some other major institutional firm who purchases dollar-denominated debt issued by a central state-owned enterprise, maybe a firm like State Grid Corporation of China, which uses a financing vehicle domiciled in the British Virgin Islands. Again, in the official data, this would be attributed as a US investor holding the debt securities of a BVI company, not a Chinese company. So there's an equal number of interesting distorting structures that exist in the opposite direction as well, China to the United States. But this is illustrative of the types of challenges that exist in trying to get a true grasp on the measure of portfolio investment securities holdings between the United States and China. So how have we solved this problem? And my goal is not to go into a tremendous amount of detail here and dive into all of these granular details you see on the slide in front of you, but high level, we've used a top-down methodology that is based on a series of estimated adjustments to official data on securities holdings between China and the United States to arrive at better measures of the true scope of two-way securities investment at the end of 2020. We've incorporated insights from academic research. We've examined various proxies for financial flows mapped in official data with known distortions. We've made some educated guesses, and we've arrived at what we think are reasonable lower and upper bounds as of the end of 2020. Some of these adjustments are described here, but like I said, I'm not going to go into a tremendous amount of detail. And then just in terms of being thorough in our coverage, our estimates are meant to cover all bilateral holdings of equity securities, including public and private, as well, falling below that 10% ownership threshold, as well as all debt securities, including bonds, private placements, asset-backed securities, and others, whether they be issued by government or private entities. As a result, we include some holdings that do not technically fall into the portfolio investment category in official balance of payments frameworks. So for example, in that slide that Dan showed and shared with you earlier, the value of reserves on China's international investment position was accounted for differently than its portfolio investment position. We try and capture the portion of reserves that are invested in US securities. So having laid that somewhat technical groundwork, I'd like to address for a moment what our key findings are, looking at both directions. And I'll first address US holdings of Chinese securities. High level, we estimate that US entities held something like $1.1 trillion worth of equity and $100 billion worth of debt issued by Chinese companies at the end of 2020. That's about 4 times the holdings captured in official data, which you can see here on the left-hand side, the TIC, the Treasury official data that were supplied as of September 2020, show only $211 billion in equity and only $30 billion in debt holdings as of the latest available data when we went to print here. Looking a little bit more closely at the equity disparity, the disparity between our estimates and these official figures are mostly a result of firms from China using complex international structures to issue equity securities on US stock exchanges, which results in US holdings being attributed to tax havens instead of to China in the official data, as I laid out in one of those scenarios from one of those previous slides. It turns out that US investors own Chinese offshore equities at much higher rates than they own onshore equities, although the value of direct onshore equity holdings in the official data is also growing rapidly. And despite uncertain legal treatment in China and growing regulatory pressures in the United States, as Dan laid out in the introduction, this overseas listing activity really continues apace. Chinese firms raised $19 billion in primary and secondary offerings on US exchanges in 2020, a total that was eclipsed only in 2014 thanks to Alibaba's blockbuster $25 billion IPO that year. So taking away that one transaction, it was a record year for new Chinese equity issuance in the United States. In the debt space, while holdings of debt securities issued by entities from China are an order of magnitude smaller than holdings of equity securities, US investment in Chinese debt securities has grown more rapidly than investment in equity securities during the last 2 years. And this is mostly a result, we think, of widening interest rate differentials between China and the United States, making fixed income in China increasingly attractive compared to what you can find here, and also a result of China's continued efforts to improve access to its onshore bond market that have really ramped up since 2016. Again, treading just really high level here and looking at the results of our analysis for Chinese holdings of US securities, we estimate that Chinese investors held something like $700 billion in equity and up to $1.4 trillion in US debt at the end of 2020. In comparison, official US data, which do include a portion of Chinese reserves holdings in the green bar here, report $240 billion of equity and $1.3 trillion of debt holdings as of the end of September 2020. So the disparity between our numbers and the official sources are not quite as dramatic in this direction. In the equity space, most of the difference between our estimates and official figures are accounted for by equity investments misclassified or uncounted in official data due to investor efforts to either circumvent Beijing's stringent outbound capital controls or to the use of investment intermediaries like Hong Kong. A lot of money that comes out of China and gets invested abroad, including in the direct investment space, the securities investment space, often is parked in Hong Kong along the way, and it has distortive influences. These distortions are in aggregate actually very difficult to measure, but we estimate that the true value of Chinese holdings of US equity securities may be twice as large or even more as the numbers reported in official data. Looking at the debt side, debt securities actually account for the bulk of Chinese holdings, which is the opposite for US holdings of Chinese securities, with most of these holdings consisting of investments in US Treasury and agency bonds, presumably as part of China's foreign exchange reserve holdings, which have measured in the trillions of dollars since the late 2000s. And then just one note on key differences. I mentioned a moment ago that while US investors have tended to prefer ownership of Chinese equities, Chinese investors in US securities have preferred lending to the US government and US corporations at relatively low interest rates. So there are these interesting systemic differences in the patterns of holdings in both directions, and they have implications. First, US investors tend to exert a larger control component over the companies in China, even through these passive securities investments, than Chinese securities investors enjoy in the United States. There's also likely a very large difference between the expected returns on the two aggregate portfolios, since so much of China's holdings of US securities are allocated to low interest rate treasury bonds, whereas most of US holdings of Chinese securities are allocated to much higher expected return equity securities. So what are we to take away from all of this? Just to step back and look at all of these numbers in aggregate, whereas the official data show only $240 billion worth of US holdings of Chinese securities and about $1.5 trillion of Chinese holdings of US securities in their most recent release near the end of 2020, our estimates really expand in both directions the true scope of what we think the values are. For the US to China direction, we see the total at as much as $1.2 trillion at the end of 2020. And for the China to US direction, true holdings we think are worth more than $2 trillion. So in combination, the value of this bilateral financial securities investment ties relationship is north of $3 trillion, which is really a staggering number. With that, I'm going to step back and having addressed just our high-level findings, give Dan an opportunity to talk a little bit more about the macro implications and outlook.
Adam, great job. Thank you so much. It's pretty complicated stuff, but the team, I've done a terrific job, I think, at Rhodium of trying to boil it down as much as possible so that people can get their head around it. And I will point one thing out for some of the eagle eyes in the audience. We labeled the graphic that Adam just finished on mainland China, and it does not include Taiwan. I'll go ahead and point that out rather than wait for somebody to ask us about it. That's because our data set does not cover Taiwan, does not cover Hong Kong. It only covers the economic area of mainland China and uses data sources that describe it. So no gotcha to the professor on that one that will make our lives difficult around the political considerations. This is a chart we like to use a lot. It's describing China in the world economy in 2000 versus the most recent year where we can get data across all these different fields. And I used the term normal before. What would happen in the future if China were normal, if China were weighted, either to what OECD economies are like or to its population weight. You see on the far left there, 20% of Earthlings are Chinese, 18% in 2018, in fact. And in terms of GDP, gross domestic product, and then goods exports and imports, and even inward and outward FDI, China has made great strides toward having a weight in the world economy that's not so unlike its population size. But on the far right of the chart, you see why we say that financial globalization really is the next frontier and that it's only just in its infancy. China really hasn't gotten out of off the training wheels yet in terms of its financial interaction, either in terms of inward portfolio or outward. Only 2% of global inward portfolio, 1% of outward is Chinese today. That is nothing like what the future will be. Even if we have these policy headwinds continue, things are going to change a lot. It's crucial that we get our head around the data better to see where we are on this normalization curve, and that we understand how much of this is China being exceptional and having an overweight financial presence in our markets, let's say, as some of the hawks who just went to the beach last week told us, or rather, whether China is still quite underweight what a normal, typical global footprint would be in finance. This kind of analysis, I think, provides very powerful context, which is crucial for us to think about. Next slide, Adam. Again, if we think about the number and the seriousness of very dramatic policy moves that have been taken over the past couple of years, and pretty much we have just demonstrated to you, I think, beyond a reasonable doubt, that by definition, all of these moves were taken in the dark with regard to what the real financial footprint between China and the United States is. It's just the fact that the official numbers and data do not yet do a very good job. And even to the extent, therefore, that our policymakers were taking full account of what data was available, which is debatable, we cannot say with any confidence that they had an adequate analytic framework to work with. That is both a critique of the past, and it's also a warning to the future. That current team, of course, is in a hurry to come up with the right ideas to reshape policy going forward, but we have a lot of kind of classroomy sort of work to do to make sure that we're proceeding with clear ideas in mind about what the setting is. And I've spent 1 year at the White House. I know that nobody in that job ever thinks they have time to study or read anything more than one page. But it's just quite urgent that we, in fact, make time to do that. Final slide, Adam, and I'll close out with this, that this very slim report, which is only numbered in pages in the 20s, is just a starting point for discussion of many questions. It's not meant to resolve very many questions at all. It's meant to take a big step toward standing on the shoulders of some other great researchers to put a clear picture of the numbers into more general circulation, so that we can then start a whole bunch of really tricky and tough discussions and debates. Many of those questions are going to be about national security implications. And the brief bullets on this slide that I want to leave you with are to point out what some of those are. We like to say at Rhodium that there are circuit breakers on China's financial future. And what we mean by that is, if China grows its financial system, but never faces any kind of financial instability or crisis or recessions or hard choices, then of course its firms would never die or face painful consequences, no matter how much financial leverage they took on to be bolder and bigger competitors. And if that never happened, that would mean our firms don't have a chance in hell of surviving out into the future, because no company can compete with a company that has unlimited financial deep pockets. But that is absolutely not the case. The picture of China financial globalization that I showed you to 2030 is contingent on China doing an awful lot of really hard reforms that Xi Jinping, in fact, has tried to oversee the past 7 years and had a pretty tough time doing. They've managed some of them, but other big moves, normalizing the renminbi, making it internationally tradable, opening the capital account, cleaning up the interbank market, all sorts of things that Constance and Mark live in and deal with every day as they think about the opportunities there for their clients and themselves. There's a lot of work that hasn't happened in China yet. And either China will become more financially reformed and liberal, and thus its companies will not have a seeming financial unfair advantage, or it will not have the kind of financial deepening and growth and big global footprint that I described a second ago. You can't have both of those. And so to American policymakers who feel like it's almost a choice they have to make now between, standing up to China's unfair financial advantages, such as they are, or staying open to American participation in Chinese financial deepening, it's actually a false choice, because China can't have it both ways. They're going to have to work through these reforms. And as they do, it's going to be a little less scary to imagine China 10 years from now. This is a time of great strategic difficulty of being confident around things like that. This report in no way fully unpacks and addresses that question. Maybe, Steve, that's a topic for another evening. But it does start to improve the data so we can move toward a more rational and smarter conversation about these things. Thank you very much. And we're super excited about the panelists and the conversation.
Great, it's terrific opening. Yes, and here I was just going to suggest we post the the link to the report, which we just did on the chat. So those of you who want it, and I think the slides are pretty much all, Adam, they're all subsumed in the report. There's no need to put the slides, a separate link to the slides.
We can absolutely provide that if there's demand, but a lot of it is in the report, yes.
Yeah, I see some people I see in the chat had asked if we could put the slides up too. Constance, if you can turn on your camera, you want to comment for 10 minutes.
Thank you. That was great, as always. It's just such an honor to participate in this conversation again this year. So I thought I'd start at first by setting the stage a little bit, because some of the flows this year are a little different, in part due to what happened with COVID than they've been in previous years. And fortunately, Rhodium's done a good job at putting this year in context and looking at the broad trends out a decade or more that we might expect as a result of China's size. So first off, I'd just like to start by saying that total foreign investment, for example, in US Treasuries this year barely grew. It grew by $150 billion. And you may ask, why is that? Well, it is in part because of the fact that US savings grew dramatically as a result of the pandemic. People were unable to spend money on a number of services that they would normally spend money on. And fiscal assistance helped give savings support to families across the country. And so as a result, we're at about $1.5 trillion more savings this time this year than we were this time last year. And then in addition, the Fed increased their purchases of treasuries by about 70% to almost $500 billion. So those two things combined really meant the US didn't need to rely on foreign investors to buy 1.7 billion net issuance of US Treasuries. So in terms of official flows for this year, just globally, we have fewer flows into US Treasuries. And then as far as Dan was saying with regard to what is, quote, a normal economy investment. So if we just look at, for example, again, Treasury data, which I think is the clearest to see, the UK has about $10 billion of holdings in US Treasuries. Likewise, Japan has about 10 billion, Hong Kong, 6 billion. So it's very reasonable to expect that if we look forward 5 or 10 years, that we would have significantly larger portfolio holdings from Chinese domestic investors into the US capital markets. And then I just want to think about a little bit some of what Dan was saying with regard to this choice between stability and financial flows. And I think that would be true if China were a small open economy. So many emerging markets face this conundrum of having foreign direct investment come in. Usually a domestic event will occur. Foreign investors in portfolio holdings will pull out money. That'll have currency implications. And this happens in small economies. So if we think, for example, of Thailand in 1997, when investors fled and the baht fell, that had implications, of course, for the Thai economy. But Thailand's a small, open economy. China, very much like the US, is a large, fairly closed economy, right? So this makes a difference. And China can certainly support capital flows. And not have it be exceptionally disruptive to its economy. And I would further submit to you that that is one of the 5 criteria of being a reserve currency, right? In order to be a reserve currency, you need to have a large enough, closed enough economy that capital can flow freely in and out of your country, and your currency can fluctuate without having a significant impact on economic outcomes for your country. And so, in so much as China has any kind of aspirations to be a global reserve currency, they're going to have to kind of get over this concern and realize that it might not be the heavy concern that they think it is. And then I would just say on the other side, one thing that we've seen globally, of course, is this move towards ESG investing. So it is the largest growing area for portfolio allocation. We are increasingly seeing methodology to account for that, to do ESG accounting so that investors have a clearer picture of what they're investing in.
You may want to tell those in the audience who don't know what ESG is.
Sure. It's environmental, social, and governmental.
First, they didn't read the BlackRock letter from Larry.
That's right. Yeah, I'm sure Mark can supplement my comments here. But this is going to influence portfolio allocation. So even, for example, within emerging markets, there are indices like the Life and Liberty ETF, for example, which allocates based on these ESG criteria. And so as such, they really don't have a high portfolio investment allocation to China. In fact, I think they have a 0 portfolio allocation to China. And so even though this investment in China is largely passive, that isn't to say that passive investors have no implication or no influence on the markets that they're investing in. So I think we're going to see an intersection between this desire for diversification and this amazing opportunity that is the Chinese market, with the preference from investors to really make sure that they are allocating in a way that fits with their values, and right now that is an ESG intersection. So I think when thinking about future capital flows, this is something that increased governance within China is going to improve capital inflows and improve the stability of that money going forward. So I'll stop there and look forward to hearing Mark's comments in our discussion.
Great. Mark.
Well, first I want to thank Steve and the National Committee for having us. Thank you. Just to introduce myself, at BlackRock, I'm responsible for a number of ways that our clients are connecting with China. And I'm going to try to give you the story about where we think they're going and why, and how that fits into a picture that I think is supportive of what we heard from the Rhodium team about the capital markets integration continuing over the next decade. And those lenses are, we have global investors around the world who want to invest in China. We help them do that. We have clients in China, chiefly institutions, who want to invest in the rest of the world. And then last, we have clients in China who want to invest in China. And those are the three different lenses that we think about that are, I think, relevant for understanding what's going on here. The big takeaways are that the level of portfolio investment in China from around the world is extremely low relative to any kind of a priori model that anybody would ever come up with. It's in its infancy. I think Dan used that phrase before. And the level is going to grow regardless of the policy of any individual actor, including the United States. Those numbers are all going to go up. And let me try to explain why. There are two strong forces that are coming together that are relentlessly increasing these portfolio integrations. The first is capital account liberalization, which has been a 20-year policy, deliberate plans set by the Chinese government. And it's been in active motion for a decade. The second, I'll come back to that in detail what I mean. The second is that all over the world, global securities investors, bonds, equities, by the way, the same thing would be true for private markets like private equity. It's actually much more advanced than these public securities world, which I think is consistent with what Dan said before. Global securities investors all over the world are way underallocated today, and all of them intend to have higher allocations to China over time. So those are the two forces. China's opening up and encouraging greater flows of capital from outside, and global investors who actually have the capital are seeking to enter China. So in the first, just to give you the arc of the story, you have to start with the Asian financial crisis. The Chinese looked at the 1998 mess through many emerging markets and said, we don't want that. We're not going to do that plan. And so that is when they began on a massive buildup of FX reserves, which is obviously in the trillions today. But another is, and I think this is an important point, it actually wasn't portfolio finance that led to the challenges in emerging markets in Asia, because when an emerging market bond or equity is sold, it doesn't actually leave the country. It just gets deflated in price. It was bank finance. It was the banks pulled their lines, typically in hard currency, and that led to those crises. And the Chinese took this and said, we're not doing either of those things. We're going to build slowly a financial system that isn't subject to those concerns. So they went on a multi-year journey of currency conversion, convertibility, capital control liberalization, and then just, and I'll talk about this at the end, integration of financial institutions across national boundaries. So they started 10 years ago with offshore RMB markets in Hong Kong and dim sum bonds. In 2011, they added RQFI to the strange QFI quota. These are happily, if you don't know these terms, you don't need to know them anymore. They just meant ways of restricting capital flows into China. 2014, they started experimenting with something they called Connect Hong Kong, Shanghai Connect, which basically allowed investors in Hong Kong to start buying securities in Shanghai as if they were actually domestic Chinese investors. In 2017, they added Bond Connect, which is the same thing, just to make it easy to buy bonds. Along the way, the Chinese, or I should say the IMF, added the RMB to the special drawing rights, which is a totally symbolic act, but it does suggest an effort towards convertibility of the currency. And then in 2017, all of the big index providers, that's MSCI, it's Bloomberg, it's FTSE, all started actually increasing their allocations to China. So the basic benchmark, whether you're an index investor or you're an active investor, you think in benchmarks. And all of those benchmarks, the global benchmarks for emerging markets, for global bonds, all started including more and more Chinese exposure over time. So that's all kind of forces that are basically saying money come to China. Well, from the perspective of the actual holders of capital, if you look at almost any portfolio of almost any individual or institution around the world, you will find that Chinese investments will be a very small percentage of that portfolio. If from the Chinese perspective, you'd see that only 3%, the People's Bank of China says, that only 3% of Chinese securities, equities, and bonds are held from people outside of China. So that's a very, very low allocation relative to what you would see for any other large economy. And the logic for change is not just that the Chinese government wants people to invest there, it's actually why investors are moving money. From a portfolio equity investor's perspective, it's very simple. First, China's buried in the emerging markets category. That's the main way people have China exposure, is they own emerging markets. That's a category that's 40 years old. I question its relevance anymore. And especially as these inclusion ratios, in other words, how much of China is counted as part of a global index, keeps increasing, what we're finding is eventually China will become half the EM index. I'm not sure that concept has any meaning at that point. People will consciously be thinking about investing in China. But that is increasingly what they're doing when they buy EM. China has a much lower correlation than general EM to developed markets. In equities, it's 0.4 as opposed to 0.6. Now, some of that has to do with the fact it is a closed market and it'll probably converge a bit more. But the other part is, and I think Constance just spoke about it, China's not a small open economy. It's a huge economy. Sorry, lost you there. And so we may see that correlation persist. The growth trajectory in the US is clearly superior to the US, which attracts investors from all over the world. That leads to the equity demand. For yield, and I think Dan spoke about this before, it's a yield logic. It's very simple. Treasuries earn sub 1% right now. Chinese sovereigns earn about 3%. If you buy Euro bonds, government bonds, German bonds, you earn a negative yield. If you get yen, you'll get a 0. So if you want yield, you're going to go to China. And to give you a sense of how quickly that money is flowing, and Dan's absolutely right, it's extremely hard to track this money, but you can see it in your own funds. We had a fund that about 14 months ago that was $250 million. It's a China bond ETF in London. So it's domiciled in Europe. Everybody except the US buys there. And it went from $250 million about 14 months ago to $7 billion today. That is extremely fast growth. That reflects that thirst for yield. So that's the stories of these two things coming together. We think this is very early. Infancy is right. We're going to move into adolescence. And eventually, many years from now, we expect that China will be a significant part of everybody's portfolios globally, for anybody who's globally allocated. I just want to quickly just mention that the Chinese are also encouraging, taking, I would call it the final chapter, or at least in this volume of the story, about opening up the domestic financial services market. And their goal there is to encourage foreign portfolio investing and familiarity with the Chinese markets. But it's actually also, and this is very important, it's to develop the domestic markets. The reason why the Chinese government has finally decided to allow asset managers to enter into the domestic business there, and we are one among others, is that they're saying we need foreign expertise and capital to come to professionalize and institutionalize these markets. If you do a survey globally, you would find that China stands out as almost like Alice through the looking glass from the perspective of a global investor. Nothing works like it does anywhere else. Derivatives is actually a retail market in China. The share market, what the Chinese government is seeking is someone to institutionalize that. This links back to this portfolio in connection, because part of what the Chinese government is looking for from the outside world is actually, sorry, we got here. Turn off the do not disturb. Can you have me there? Great. Do not is what they're seeking is a professionalization. So I just want to pause there and just recap what we're talking about here, which is capital account liberalization, 10-year plan of active motion, combining with positive yields and a logic where Chinese equities ought to be a bigger part, just starting from scratch, of anybody's portfolio, and a market cap weighted should be 5, 10, 15, 20% of people's portfolios. But right now you'll find it's almost zero. We're very close to that. We're just buried in an EM exposure. Put those forces together, and regardless of the policies of any individual country, you will see those numbers rise over time.
Fascinating. Very, I mean, this is an both amazing data. I mean, stunning that our public data can be so off, leading to, that's significant. $1 trillion here, $1 trillion there. Dan, you start talking about real money. The question, I guess, is, we're hearing from started with this one, we're hearing from the new administration that financial services opening in China to American firms, which was a big deal to the previous administration, is not a big deal to this administration. Jake Sullivan has stated that quite explicitly. How do you respond to that? I guess start with Mark, because obviously it's very important to BlackRock, but also want to hear from Constance, Dan, and Adam.
Well, first I want to thank many administrations, probably 5 or 6 in a row, that have been actively seeking to expand the opportunities for U.S. financial institutions in China. So it's been going for a very long time. It is true that in the phase 1 agreements, there was specific call out for asset management. I really want to thank the folks at USTR for helping us there. I don't think they really did it. This is a deliberate policy from the highest levels of the Chinese government to encourage a set of Chinese asset managers to learn from and work from foreign asset managers. That is the plan. And so you saw quickly that, for example, JP Morgan was allowed to own 100% instead of 49% of their fund company in China. We were allowed to start something. These reflect, I think, domestic priorities, which are, 1, institutionalization and professionalization of that market, but also 2, a desire to help on the retirement crisis. If you're a policymaker in Beijing, what you're thinking is, and you're worried about economic and financial policy, very high on your list is this retirement crisis, which is as severe in China as anywhere in the world. And they're desperately looking for foreign players to come, not to contribute capital, but to contribute know-how based on the rest of the world on how actually to build savings products that actually will help take some of the burden off of the Chinese government.
Dan, or Constance, you want to say anything on that?
Totally agree with Mark. Chinese were chasing Donald Trump's plane down the runway after his visit to Beijing, trying to get him to sign a financial opening agreement so that they could say, we did it because the foreigners pressed us to. But the reality is China needs to get its door open for its own sake because of the retirement crisis, as Mark puts it, which I think is super important to underscore that. And just systemically, by keeping these buffers in place for so long, China prevented itself from being exposed to an Asia financial crisis problem, but it created a different problem, which is that its strange ecosystem has not been stress tested the way that others have. And it permits the leadership this special political access to the financial system, the banks especially, to ward off all sorts of other growth problems. But that has undermined the efficiency of financial intermediation in China. And it has embedded all sorts of structural risks, frankly, in that system. Now, Beijing has no choice but to ultimately make itself interoperable with a very dynamic, very stress-ready global financial system if it's ever going to get out of the crosshairs that it is, put itself, by solving one problem, has created a different one, I think. So I just completely agree with the way Mark described that, and I would add to it that China doesn't need Washington to push the door open in finance.
Yeah, and I'll just agree with what Mark and Dan have said. I mean, I don't think this is a priority necessarily of the Biden administration, because it doesn't have to be a priority of the Biden administration. And certainly the yield play on Chinese bonds is attractive enough in its own right. And one of the things, if you're looking to solve a retirement crisis, right, nothing helps you forecast future investment returns like a steady stream of incoming capital flows. So this is in China's interests, and I wonder if one of the reasons it doesn't have to be a priority of the Biden administration is that it's already sort of taking care of itself.
By the way, I think in addition to the yield kind of benefit you get, we're seeing this inflow is creating appreciation in the RMB. So if you're a dollar-based investor, not only you're getting a higher yield, but you're getting the benefit of RMB appreciation. We've seen the from 7 to 6.5, Dan? You want to?
I would stand with Constance and warn you against chasing those short-term dynamics that are moving the exchange rate around. But that has been a big kicker that made the deployment into Chinese bonds, not only the yield, but the exchange rate gains there, if you take that presently, is tremendous. My other colleagues at Rhodium have strong ideas about what's going to happen with renminbi this year that I'll leave for a different time. But for the moment anyway, it's been a big factor.
But what struck me when you talked about the 20, it was also the conversation I had with Ray Dalio on our Chinatown Hall program. If, he's 3% allocated, he says, I'm moving to 15% allocated. You talk about 15 to 20 trillion dollars of flow into China.
Yeah.
Realistically, they're going to have to appreciate the RMB, and investors have to take that into account. Whether it appreciates from now through next July, you don't know, but over a 5 to 10 year period, it's a pretty good bet.
There's a heuristic we use that the outflows are hardwired and the inflows are contingent. And what we mean by that is that unlike the typical global saver, Mr. Joe, your average Joe in China, is about 99% home biased in their life savings. Everything they've ever earned is tied up in one asset class, property, in one emerging market, China. And even if you're long China, which I am, Lord knows, that's not great portfolio theory. And so, given that China has the largest money supply in the world, the largest marginal growth of savings on the planet, bar none, we're definitely going to see even a modest amount of normalization of the non-home bias would mean many, many trillions of dollars of outflow. The world, starting with Mark, is super ready and eager to deploy correspondingly large amounts of money into China. However, there are a few prudential and fiduciary obligations, such as you need to know that capital account is not just experimentally open, but if you're going to put $10 trillion in the country over the next decade, it has to be ironclad that China's bank is not going to step in a crisis, in the next crisis, as it did in the last crisis, and lock the doors and send in a national team to start stabilizing the markets the way they did. Now, Mark has different, much more sophisticated point of view about that than I do, I know, but this basic idea that outflows are hardwired, inflows contingent on reforms that I'm confident are going to happen too, but we got to see them happen to make this math fully play through.
A lot of the questions that are being submitted are similar to one that I've asked, but Nick Borst asks it nicely. He says, U.S. policymakers have powerful tools of economic statecraft available to them, such as limiting access to our capital markets, as we've seen, and flows from U.S. investors, as we've seen. However, if we overuse these tools, we may end up damaging the preeminent role the United States plays with the global financial system. What is the right balance? Mark, you want to start with that?
I would say the horses.
Go ahead.
Go ahead. Sorry, Constance, please.
No, I was just thinking. You go first.
Okay. Well, I'd say respectfully, the horse is out of the barn. We have permanently damaged from the Chinese perspective, the reliability of US capital markets. And we have taken Hong Kong, which was a left for, I don't know about dead, but left for senescence market, and reinvigorated it. The future capital market center for China is Hong Kong. It's not New York and it's not Shanghai. What we've done is actually, interestingly, and I don't think it was a particularly considered policy by Congress nor by the Trump administration, is in a unilateral way, we've basically said, if you want to invest in China, you'd best go directly to China or go to Europe, to the vehicles there. And so that's kind of the message that global investors have taken, which is, I'll just buy my securities, even if I'm a US asset manager, I'll buy those securities in Hong Kong or increasingly Hong Kong, as opposed to things that would have otherwise been listed here. So I think that the question of balance is, unfortunately, I think we already tipped it. Whether that is good long-term for national security, I leave to others, but I do know that in my view, the horse is out of the barn.
Irreversible?
Irreversible is a very strong word, Steve. You would need to have some form of concord, some broader agreement on the role of portfolio finance, so that Chinese companies were more secure in accessing US capital markets directly, as opposed to what is going to happen and is happening now is they list in Hong Kong and exactly the same portfolio manager simply buys the Chinese or Hong Kong security as opposed to buying a US security. That's all that's changed.
Constance, Dan, Adam?
Well, I would just say, since money is fungible, as Mark has pointed out, in a way, it's a little bit of a toothless policy. But of course, in another way, our capital is one of our greatest weapons. And so by saying that we're going to officially limit access to US capital, it's certainly sending a strong message. And I think what has to happen in order for this to change is better relations with regard to US, China, or probably China and other international security organizations, and how they interface together. I think we're not going to be able to paper over this by just changing or reversing the financial rules, right? Because the congressional action was bipartisan. So there is a strong sort of desire that some lever had to be pulled here, and that lever wasn't going to be a military lever, so it was a financial lever. And I think we need to address at a fundamental level the coexistence of two military powers, the US and probably a growing China military power, in order to fully resolve this.
Dan? Or Adam?
Good. There's a lot of great questions in the chat, Steve. I'll let you curate.
Yeah, if it's all right, just 30 seconds, just revisiting some of the data pieces that I talked about earlier in the presentation. A really interesting statistic that we discerned as part of this exercise was realizing again that 2020 was like the second biggest year for new equity issuance among Chinese firms on US exchanges, just barring that 2014 year with Alibaba. There's a little bit of variability among the quarters. The fourth quarter definitely saw a slowdown in momentum, but it didn't slow to zero. There were a couple of pretty high profile IPOs on US exchanges involving Chinese firms. And so even with all of this swirling around, Holding Foreign Companies Accountable Act and pushing the SEC to adopt harder guidelines that would force delisting if there's not compliance with accounting standards, threats of delisting through executive order, all that didn't bring it to a halt. So
but
I can see,
has the spirit, except they've all listed in Hong Kong at the same time. So what's happening is they're all buying their own insurance policy, which is they can't rely on US capital flows and access. And I think that's a very big change. That wasn't true 5-7 years ago. Tech firms listed here because it was where they could get the best valuations. And that's a big change.
Agree, absolutely. But we'll just add for some flavor to the conversation as well, pointing out that I don't think it's clear to Chinese tech firms writ large that listing in Hong Kong or on mainland exchanges is without its potential pitfalls, as Ant Financial is realizing. And so there are still things like valuations and rule of law expectations in the US that some Chinese firms find attractive. But I do think it's an open question if the U.S. is going to be able to ever sort of reattain that level of prominence, especially vis-a-vis Hong Kong, like Mark mentioned. Yeah.
Without having coordinated these policies with other markets, it was simply playing whack-a-mole, that by denying them access here, it just popped up in London, in Singapore, and especially in Hong Kong. And that it was a policy, from my perspective, that was so ill thought out that if it's the right policy, then you got to coordinate, as President Biden is saying now, with our allies. Otherwise, you're just punishing the lawyers, the accountants, the banks in the United States that don't have presences in Singapore, London, Hong Kong. Catherine Pan asks a very interesting one, quite specific. Can you please, hosts us when we used to have physical meetings, would be our host at Dorsey and Whitney. Can you please comment on the impact of DOD's and OFAC's Communist Chinese military list and the related executive order and OFAC guidance on U.S. investors' ability to invest in Chinese companies' stock? Anybody want to take that one?
I mean, I can make an observation about it, and others might be able to say something more clear about the implications in the market than I can. But I will say this, that it's entirely appropriate for the government of the United States to have policies, rules, and the ability to step into financial flows that benefit firms that are, legitimately defined as being somehow hostile to the interests of the United States or to present a direct threat to our national security. I don't have a problem with that. I don't have a problem with traditional American OFAC, Office of Financial Assets Control, the Treasury type authorities. I don't have a problem with the Defense Department's ability to step into the debate about what is national security concerning and what is not. We live in an extraordinary time in which the nature of the vulnerabilities that new technologies present has evolved so quickly that it's overrun our traditional expertise and ability to discern what's a legitimate government, necessity of stepping in and trying to change financial flows, and what is some other agenda hidden under the guise of national security, right? And of course, so much of this happens in classified world that we're not privy to, that we're told we have to take it on faith, which is all the more difficult after an administration such as the one we've all just lived through, those of us still living who can be on this call tonight, right? We really need to have a larger discussion about how to update the relationship between our defense function in America and our economic leadership role in the world. It's not, entirely surprising to me that some of these really tricky questions around what was necessary and what was not arose the way they did. The manner in which they were handled has clearly raised more questions than it has resolved them. And it's made it very difficult for other advanced liberal democracies to work with the United States to develop a shared approach to dealing with these concerns. Yeah. So that's what I think about it.
My point is really a narrow one, which is whatever we decide, we can decide. But if others are not with us on it, it is pointless. We simply are punishing Americans, and we're doing.
It depends, Steve. It depends. In some areas, like for example, take all the work we did on venture capital together the past couple of years. In most areas of real high tech,
he's talking about portfolio investments, Dan.
Yeah, no, I know, but
we should not. I mean, if it is not done multilaterally, it's pointless.
Look, I think it's
I have run an investment bank in Hong Kong. I can assure you, it didn't really matter to us. If it ended up being issued in New York and ended up being issued in Hong Kong, I got the same fee out of the deal.
I understand, but Steve, I think the theory of action among the more thoughtful hawks in Washington the past 4 years was that other liberal democracies also were uncomfortable with some aspects of being interoperable with China, and that by standing up and showing that it was willing to act first, the United States could impel a coalition of action. Unfortunately, it was done so poorly, in my opinion, that the prospect of that actually happening, was never a very good one. But I think you're absolutely correct that if it's always America alone on this, it's not going to really have the desired effect.
It is costing American jobs. These policies are costing American jobs. And I think it's important when we have a discussion like this that we should be conveying to the new administration that this stuff needs to get reversed quickly, because American firms are losing their market leading positions. And to the extent that this continues to erode, it's costing us jobs in New York, Chicago, Los Angeles, you name it. It's costing us jobs. We are losing.
That is true, but that's half a ledger here. We also have to look at the legitimacy of the national security considerations. And there are things that a country like the United States may have to do that cost jobs, but have a legitimate national security purpose. So we have to look at both sides and make a decision. So the report today is meant to provide a better information starting point for that kind of a cost benefit analysis.
I see Catherine asked the next question, which was, do you think the Biden administration will reverse these decisions? Anybody nobody wants to offer a guess. How do you think, a number of questions have come up, and Dan, maybe you know the most about this, about the EU-China investment agreement as well as RCEP, that China's signing both of these? And does that suggest to you that these countries are not going to be moving along with the United States with respect to cutting China off from capital markets? Patricia doesn't give her last name, ask them.
Our European friends would point out that the United States did its phase one agreement first, and in fact borrowed some of the terms in it that were meant to be going into the CAI in Europe. And so they were only sort of trying to keep pace with American, having a separate piece approach. I think that we'll see how the RCEP works. It hasn't worked brilliantly for protecting Australia's economic interest yet, but give it some time, and we'll see once the CAI is finished in about a year and a half or two, how it's implemented. Then we'll demonstrate whether it's an effective approach. I'm sure Mark has a perspective, Constance probably on those things too.
I actually, Dan, I largely agreed with you. I just think we have to keep coming back to there's an illusion in Washington that if we just say stop to something, that everyone else in the world will somewhat follow, or it won't be that big a deal. And the problem is we're a much less relevant country than we were in 1960. I just think that if we, coming back to something that you've said, that Steve has emphasized, if we had, in all this, I completely see the point of suspending finance, offshore finance to Chinese military entities. I can see the logic behind that. I make no viewpoint on it, but I can see the logic. But doing it by blocking off, it's like blocking off like one lane of a 9-lane highway. You're not doing anything. And I think that's the key thing that we have to take in terms of policy is we have to work in concert with the other big capital sources, particularly the Europeans. And if we do that, we're far more likely to be effective. I'd also say that regarding the particular OFAC and the most recent round, really the last quarter in Q4, the administration, the pure execution of them was clearly without any interagency process. It was like people were throwing stuff on the wall and publishing it, reversing decisions 24 hours later. It was a real mess. And I would say it just reflects the lack of consideration. It was an urgency to do something. The world's complicated. We're going to have to bring some other people along to, quote, do something.
Yeah, I would agree. We're going to have to be much more thoughtful, much more comprehensive in the way we approach this if we're going to be effective.
Betty Louis asks about, I don't know if you want to get into this. Can you give your thoughts, insights on the DCEP, the digital yuan, and whether you believe this will lead to the internationalization of the RMB? It's kind of outside. I guess it relates a little bit to capital, so it's a bit outside of what we're talking about today.
So I'm happy to come in on central bank digital currencies generally, right? So the idea being that it's a much more efficient way to distribute fiscal assistance directly into a digital wallet. To the extent part of your population is unbanked, for example, it can solve that problem. And so I don't know how the internationalization of digital currency is something that is still being worked out, right? So if you're going to be able to take a closed blockchain system in one country and take a central bank issued digital currency and exchange it for another central bank digital currency, unclear to me that whether that increases cross-border flows or actually in some ways stifles them, especially if these are the closed systems within the countries where this currency is issued. So it's really a tool for central banks to take advantage of blockchain technology to distribute fiscal assistance, again, directly to the citizenry. And of course, I suppose if necessary, collect taxes down the road, right? So in terms of tax collection, it potentially has some benefits. But unclear what the international convertibility will be for central bank issued digital currency.
Right, that's right. Interesting question from Chen Zhang at the Bank of China. How well can international investors invest in China's bond and stock markets without an onshore presence?
Many of the programs that the Chinese government has put in place over the last 10 years have basically been to enable exactly what you're asking, to make it easier for non-domestic investors to buy equities and bonds. The primary thing that the Chinese government has done is say, you can buy through Hong Kong. If you're familiar with how to buy in Hong Kong, you can buy Chinese equities and bonds, A-shares. So that's the main way. But for many investors globally, they actually are looking for simple vehicles that will allow them to just simply buy the exposure and move on. They don't want to deal with the complexities of a relatively new market for them. And that's the reason why we see the growth of both active and index fund purchases by institutions who normally would buy individual bonds. Nowadays, they're buying them actually through funds. Now, in 10 years, they may buy them directly. But for now, they're buying them through funds as a simple, cheap, efficient way to get that exposure and move on. And that's, for example, when I mentioned that ETF in London, that's exactly what it is. It's just people saying, I want Chinese bond exposure. I want to just get it done today and not think about it. And in the same way that in today buying JGBs or bonds is easy for a U.S. investor or a treasuries for a German investor. Maybe one day it'll be like that for China. For now, it's significantly more complicated as people choose a bundle.
And it's a dollar-denominated fund?
No, it's renminbi.
So it's a renminbi.
No, you're buying straight into into Chinese bonds, which is what people want, without any of the hassle, at a relatively low cost. And other people offer the product. This is not an advertisement for my firm, but you're welcome to buy it if you're a European investor.
Chris Merck, longtime member of the committee, used to be running AmCham in Beijing. The PRC could take steps to improve its financial integration with the US and global markets, for example, by allowing PRC companies listed in the US and their accountants to comply with accounting rules to which all other US listed companies are subject, or resolving the legal and regulatory uncertainty of the VIE structure. Is there any likelihood of that happening?
Mark will have a professional grade opinion because I know BlackRock probably has lots of people watching the issues very closely. I can say, I can speak freely and say that I'm fully aware that the SEC and other authorities in Washington who are concerned about that issue felt that there was no insurmountable obstacle to resolving that issue of accounting concern if there were basic political goodwill on both sides. There's going to be tons of those kinds of issues, especially given that even in the most convergent possible scenario, China's not going to be exactly like the OECD economies. And yet, if there's goodwill, then folks can find adequate ways to address consumer welfare or regulator exigencies or whatever it happens to be, I think. I don't know, Mark, are there some things that are going to be just too tough a nut to crack, or what do you think?
No, Dan, I completely agree. In fact, what I was thinking was, I think there's a bit of arrogance in the US perspective on accounting standards. And there's a little bit of an anti-Chinese bias here, putting aside political concerns, which is a completely legitimate question, but call it as such. Let's remember that 2 of the top 30 DAX companies have shown to have massive governance and fraud problems in the last 2 to 3 years. No one's talking about delisting Volkswagen in the United States. And so if it's a pure economic one, I think you have to get back to what are you really worried about? And I think it comes back to the goodwill point, which is the foundation of any of this. People, so I just was listening and thinking like, we shouldn't try to dress up concerns that are actually endemic in large fragmented capital markets and blame them on China with goodwill and the Chinese desire. They really do want to improve domestic standards. There are lots of problems. Of course there are. That's why they're trying to get foreign companies to help. It doesn't help to shut them down out of the U.S. markets, because then we lose even the carrot of greater integration. My view, just my view.
Yeah, I was on a call late Friday night with a senior member of the CSRC who said that exactly what both Dan and Mark are saying. This is totally a political issue. We can resolve it in very quickly. And in fact, we offered to resolve it, but the political head of the, what's the accounting organization?
FASB.
Yeah, FASB just didn't want to do it. He was instructed not to make progress, so they didn't make progress. I assume this was done because I was not the only one on this call. This was done with a view of informing the Biden administration that this could be resolved without too much trouble, and then get to Constance's point, which is the legislation then would be satisfied, you know, that this would not be something, you know, something where we could comply where the Chinese could comply with the legislation. Clay Doobie asks, apart from politically inspired complaints about accounting standards, audit access, how might investors worry about the reliability of auditing and rating assessments, and how would that affect portfolio flows?
Well, I would say, you know, on the rating side, for example, there is some criticism of local Chinese rating agencies, and they're subject to some of the flaws that we saw in US and global rating agencies during the global financial crisis. But greater capital flows into China is likely to positively influence that. And certainly to the extent that we see greater professional investment know-how expanding within China, that will also have an influence on that market. So it'll be something that investors will require in order to deploy significant amounts of capital.
Steve, if I could just add, thank you, Constance. I agree with that. To answer the question, I'd start. You wouldn't talk about investing in the United States. You talk about a sector or a kind of company or something like that. And if you start thinking about China like that, you start to break up the capital market. You have old state-owned enterprises, and then you have extremely advanced technology companies in every sector. There you have consumer companies. There's a huge array, and probably for now, the most reliable way, if you're concerned with, I think, good reason about capital markets that are much less mature and transparent than in the United States, is to choose an active manager who is good at what she does in picking those securities. That would be my broad guidance on the equity side. On the bond side, most foreign purchases are really going into sovereigns or into policy bank issues or very high-end credit. So I think that's less of a concern there. Although again, an active manager, and by the way, we're a very large index house and an active manager, I think it's probably the way that we think that most investors will get over that problem, which is, I need a professional to help me here. And succession in this institutionalization and professionalization is actually an index fund is as reliable in China in 2030 or 2040 as it is in the United States or the UK.
What does China need to do to get there? There's, we talk about, you know, and Dan made reference to this in his remarks, that, you know, we talk about potential inflows that are truly enormous. 15 to 20 trillion is, you're getting close to U.S. total debt. What does China need to do? I guess that's mostly for Dan.
Boy,
Or
there's both a parsimonious answer to that and some very rich answers. By which I mean, I think probably the constructive, the productive thing for us to talk about are all the specific regulatory steps entailed with going from being an unopen, a developing country to being a more advanced economy. Everyone who's considered, the most predictable and mature markets in the world has gone through crises and gone through the learning process. You can't really build up the human capital necessary to regulate markets until you've gone through some pretty rough patches and resolve them in the normal way at home, So I think there's a lot of human capital formation, we would say as an economist, that comes from the experience of maturation and learning to go head to head against folks like Mark's firm, with the aided and abetted by folks like Constance's firm, to help guide you through, risk taking, which is what it's all about. The more complicated part of the answer, though, is that there is such a fetish for stability in China today, and I appreciate that. I've come to know a little bit about Chinese history, and I appreciate the tumult and terror of the instabilities of the past and the long shadow that casts. But there's such a thing as too much stability, and in order to enable this kind of market potential that we're all excited and talking about, there's going to have to be some not just economic regulatory change, but political change. And it seems to me that the political authorities are going to have to put on the so-called golden handcuffs that will stay them from the temptation to reach in and try to promote stability the next time that it's the season when the weak need to be called from the herd so that resources can be redeployed to the better companies. And unfortunately, whenever the incumbents, state-owned enterprises and otherwise, have been faced with the prospect of really being displaced by some independent new power firms, government has leaned against that process for fear of the sociological and political consequences. And so that's a really big idea and thing for a symposium rather than a quick walk through the regulatory code. But I think both are crucial parts of the answer and the outlook.
Constance, did you want to?
Yeah, I mean, I would largely agree with Dan, and I think this stability consideration that Mark so ably outlined earlier really is something that now at China's size isn't as significant. And as I mentioned, like the US, China is a large closed economy for all intents and purposes. And so now that it has gotten to this size, something like portfolio flows are unlikely, even if they grow to the size that we're all anticipating they will grow to, are unlikely to be destabilizing for an economy of China's size. So I think that by managing it the way the government has to this point, they've really mitigated a lot of that risk, and that opening up now would not present nearly the types of risks that they're worried about that we saw, for example, in Thailand during 1997.
Mark, you have anything on that one? No? I mean, Adam, did you want to add anything on that? I'm looking at this from a broader perspective. And when stability is challenged in any way, shape, or form, whether it's respect to political reform, whether it's respect to lawyers who are representing human rights activists, with respect to Hong Kong, with respect to Xinjiang, the response is always an overreaction towards stability, that it is far excessive to what we think they could do to bring the problem under control. So, when we looked at when the capital controls were put in, was that necessary? Maybe, maybe not. Was it certainly excessive? Yep. Did things dry up pretty much overnight? Yep. It raises interesting questions about, does it move to 20 trillion by 2030, or do people become nervous about doing that? And also relates to the RMB as a reserve currency. Central bank is pretty much the most conservative animal that you can find. And if he is going to hold, or she is going to hold renminbi in the country's reserves, they better be darn sure they can convert it. And if they can't, if there's a fear that they won't, they're going to limit what sits in the reserves. Constance, go ahead.
Yeah, I would just say that, you know, if you're going to enact good policy, then you don't need to worry about the stability issue. If you're not going to enact good policy, right, money will leave your country. You will see capital flight, whether it's domestic capital flight or foreign capital flight. So it is a governor around what types of policies can realistically be enacted. With that said, though, I don't think that China that should be their biggest concern, right? If they want to develop the way that they say that they want to develop, then they're going to enact policies that are going to support that development.
Steve, let me offer maybe a final thought in terms of sort of what the motivations might look like from Beijing's perspective. Think back to that net international position chart I showed you earlier this evening. What it's telling us is actually that China is a net lender to the world. China has a greater claim on the world, holding world assets, than the world is presently holding China. And there's a lot of commercial opportunity from the world being permitted to and taking the opportunity to hold more China, yes. But one of the funny things for where we are right now is that because China has been so kind of conservative in letting the market shape these financial flows, on net, China is lending the world about $1 trillion right now. And yet, because it's holding global securities that pay like 0.5% of yield, whereas what the world holds in China is foreign direct investment, as we've been working on for years, and these much higher yielding debt instruments now that Mark's helping people access. China is probably paying the world income in order to lend it $1 trillion a year on net. I haven't done those, I haven't refined those. That was true a couple of years ago and helped explain why they wanted to move into FDI from just holding treasuries. It's all the more true now as this two-way portfolio picture plays out. That's, you know, not a great performance for the nabobs of Beijing to point to, that for lending the world $1 trillion, they're probably paying the world for that privilege. So lots more questions and things to talk about in this vein.
Okay. Adam, Dan, thank you so much for preparing the report. It is truly fascinating and has provoked a great discussion. Mark, Constance, thank you so much for giving so generously of your time. This was really, really fascinating. I wish we had another 5 hours because I've got lots of other questions, but it really was a terrific discussion. I thank the audience I see who stayed with us from beginning to end, so we were right to make this a 90-minute program. But thank you all.